Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Friday, October 27th, 2023. Markets are now closed, so I'll keep this one relatively brief. I'm just going to go through the indexes, the two big ones, the S&P 500 and the NASDAQ 100. Rifle through there are 11 sectors in the S&P 500. Click down those real quick, just show you where we're at. Key levels to watch, key developments, what happened today, how we closed the week, what to expect going forward, of course. And then with that, we'll do the Mag 7, the top holdings in the Nasdaq and S&P 500, and then just not all, but some of the things in my things to watch list. Let me start out here before we get into the charts. Let me share my thoughts. At least as positioning goes. So I had a question here. As you say, you can change your mind at any moment. Can you let us know? And so here's my thoughts. This is as we close the day, and we were heading into the day. I didn't refresh this, so it says 1 second ago. I haven't refreshed the page. This was before the close. Okay, so sure, I really don't like the price action so far in the second half of the day. Tech was ready to and started to take the ball and run. Remember, the Nasdaq was up well over 1% today. Nasdaq 100, and that's what I've been trading mostly as far as indexes go. However, a lot of the other things to watch stocks and sectors that I've been highlighting recently, including the banks and other financials, are coming under heavy selling pressure. As I said recently, the financial sector has half the weighting of the S&P of the tech sector in the S&P 500. Remember, tech is by far the largest, over a quarter of the S&P 500, and then everything else is a distant second. So while the financial sector only makes half of the returns and virtually a zero weighting in the Nasdaq 100, the Nasdaq 100 excludes financials. Yet no one single sector is as important to the ultimate health and the performance of both the economy and the stock market. If the banking sector has problems, the whole world will have problems. So, therefore, the drop in the banks put the brakes on big tech. Again, big tech started out of the gates. Amazon had bucked the trend and was up, and still closed the day up very nice. Amazon did, and they didn't fade that. In fact, I'm looking. We'll go over them in a minute. Most of the things did close up positive. Either positive or flat, just about all of them, the big tech. So, however, they a lot of them gave back earlier gains, and we can always try to assign a fundamental cause. And I will not argue that Jamie Dimon's comments. I saw the headlines this morning before the market opened that he's for years and years he's just been accumulating. He's a deity in the stock market, in the banking sector, and financial sector as a whole. And so the fact that he's finally selling after years and years of just accumulating stock, he's selling some JP Morgan stock. I'm sure that played into it. However, with it being said, it doesn't matter what the headline is. What matters to me, at least, is price action. And so the banks were down, and so let me just wrap it. So I said, basically, I'll be going home long, as I stated earlier, just a little less long and mild net long position, because as I made it very clear today, the risks are nearly bilateral. I still think that it's skewed to the upside. I just can't rule out potential for another leg down or a market crash. I think that's probably what's going to take. I think barring any kind of meltdown in the futures over the weekend. Again, all those risks that I've talked about for months now, and I have to loop back to this time, they haven't abated. They've only gotten stronger. And the risks I'm referring to is any one of the dozen or so things I've been watching. Banks, regional banks, big banks, brokerage firms, the wirehouses, non-bank financials, hedge fund, pension fund, anything out of anywhere. All these too high for too long rates can crack, and anything anywhere can be the next shoe to drop, and it can come out of the blue. And those things usually do come out of the blue. Sometimes you get a little heads up, and that's why I watch all these sectors. If all of a sudden you see one bank, one brokerage firm, one company that might matter and have systemic implications if it fails, and you see that stock going down, then that's a red flag. So that's what I'm kind of seeing. Is today, again, just to summarize it, I do think we'll probably bounce next week into Apple earnings. You just can't bet it hard, because the risk, if that doesn't happen, if the things just crack, then we could come down hard. So I don't think whether you went home long or short, I give you my take again, net long in the active trading account. Just because I do think there's a good chance we're going to bounce here, and we basically close the day at where we started. Let me get back into the charts, and we'll wrap up and let you guys get on with your weekend. All right, so the Nasdaq 100. How can I really have much of a differing opinion from yesterday? Because we actually closed positive, 0.5% gain. So that means that a couple things. That so far the 200-day exponential moving average is acting as support. We had a slight close under it yesterday, only to regain and close. You can zero in if you want to do that. We closed right above on it. Again, you don't have to stare too hard, a little above, a little below. It just means it's a first pullback and test of the 200 since all the way back here in earlier in the year in March. And so that's that. You get still some potential kind of clinging on by the skin of its teeth or whatever. T2 was a target from way back up here. Remember, we had numerous objective short entries, breakdowns, back tests to the trend lines, and so that's where we're at. So it just feels to me like I don't know, nothing's changed. I think near term, I think that we're probably set up for a little relief rally as long as there's no more no shoes drop over the weekend. The financials, there's no big, all of a sudden any one big bank, either a headline announcement that there's a problem with the financials or something that's going to affect the rest of the economy or the stock market, or maybe not an announcement, but you're just watching one sector go down. And what happens is, I've done this long enough, the financial media will retrofit and try to force a headline on anything. They always, every single day, if there's a big up or a big down day in the market, they will assign whatever cause fits. Sometimes it makes sense, and sometimes it's like they're pulling it out of their just to cite the reason for a rally or drop in the market. Sometimes it's almost laughable because it's maybe opposite of what they said. If you have a big rally today, 2 weeks ago, the cause that they're citing for the rally, interest rates fears or this or that or something in Washington, they use the same reasoning for the opposite, maybe a drop the previous couple weeks. I've seen that too. So again, I'm not saying that the headlines don't always cite the reason for a move, just that's their job. They're going to come in, they're never going to put their hands up and say the Dow is down, or the S&P 500 dropped 3% today and we have no reason why. That's what I'm trying to say. So don't put too much in the headlines. The technicals and price action matter by far the most. So that's it. So as bearish as this feels and has been for the last couple of weeks, that's where 2 weeks ago, Friday today, I said I suspect Halloween will come. I put a couple posts out. Halloween's going to might come early. Hammer down. Don't feel the hammer down coming on the market this week or next, and that's been that last 2 weeks is. Kind of a mini hammer, not a sledgehammer yet. Things could break. I just, like I said, if we can stabilize, financials and some other things next week, we could get a nice little bounce up until Apple, and then market might get nervous. And again, if that depends if we do bounce and how far we go. Let me show you we'll loop back to the NASDAQ, but let me just go to the SPY. This is the chart I got out to you. So this was, and in that post I got out today, by the way, guys, I forgot to include and I added it afterwards. So by your email, you won't have this chart. This was the updated chart that probably was the missing piece you didn't realize they were seeing there. The charts were sequential. When I look at the last ones I posted on the site with screenshots for the charts, and then I took the video screenshot. And, when I was doing this video back was right here a few weeks ago, it was a golden shorting up. I said there was just so much to love in this chart for a bear. I said, this is my less busy board. I'm referring to, I have different boards, lines. And my less busy board was pretty busy. And there wasn't a dang thing bullish on there. There's nothing but bearish stuff. The head and shoulder, beautiful head and shoulders topping pattern, the divergent high, the bearish engulfing candlestick, the bearish rising wedge, and all of these were identified in advance and of breakdowns and after. There was breakdown of that small wedge also confirmed that bearish engulfing candle when we moved below it. So that was saw great sell signals there. Then we broke the secondary trend line. If you missed that, you had a back test of the trend line right there. Then you also had a pushback to the downtrend line. If you missed that, you had another shorting up right there on the pushback to the trend line. Then, as I said in one of those previous charts I posted in the and went out in today's post, that this would be a sell signal here and a major sell signal when we broke. I used the terminology when we broke in advance of it. This would be a major sell signal. It was, and a back test. And a back test again. That back test coincided with a back test in the neckline. So I know I'm throwing a lot out there, but there's just an overwhelming amount of evidence, or was at this point right here, to short or be short. I always use that analogy of the prosecution trying to prosecute a criminal defendant in court. You have to have a preponderance of evidence, beyond a reasonable shadow of a doubt. That's pretty solid bearish evidence, and then that was it. And so rejection, so that was it. You broke down the head and shoulders, you broke below the primary trend line, and that right here, what I'm circling right here, as covered in that video just a few weeks ago, there was just a mountain of evidence to short or be short or add to shorts there. Again, the back test of the neckline, the back test of the primary bull market uptrend line, all that during a downtrend and coming off that big divergent high. And so that's it. So that was a quick swoon down. But as I said today, so you have, and that's why I do these videos, that's why I talk for 30, 40 minutes. There's not one thing. It's again, trying to build up as much evidence as you can to be long or short. So you have a perfect, the measured target of a head and shoulders pattern is the distance from the top of the head down to the neckline, which is this white line. You can see it touching the top candle there, that bearish engulfing candle, and right on the neckline. That's what I covered in that video a few weeks ago. And that is perfect. I mean, an exact hit of it. Does it guarantee that we can't go down anymore? No, absolutely not. I've seen head and shoulders play out and then go right on through the measured target and never look back. But I can tell you it's almost uncanny how often these things do play out to the measured target almost perfectly and then reverse. S&P is still well below its 200-day moving averages, but I've commented on that. It tends to move above and below them. The NASDAQ has been behaving better off the 200s recently. So let's move on, wrap it up. So that's that. This is QQQ. That's still, like I said, it's more, it looks like it here. You can see the divergence there when we move these lines. So again, hanging on there, the positive divergences by the skin of their teeth, but they're still there. And that's why you need to be cautious. And, if you're heavy short right now, again, 200-day moving average. And what else do we have in addition to that? Let's run through the FANGs. We'll go to the sectors of the S&P and then a couple of the things to watch that, again, give me a little pause right now, but it may just be a one-day thing with the financials and all that. Apple still has a very big positive, aka bullish divergence there. It was up today like most tech stocks, and there's a little minor trend line here. These were downside targets from shorting it up here. T1 hit, T2 hit. These are still longer term targets, which I maintain, but I don't want to, and again, I'm not in Apple personally right now, but to be long or short the NASDAQ 100 via QQQ or NQ is to be long or short Apple, pretty much, due to its weighting. But you could get that bounce up, and again, there's other charts. I have this trend line. There's the primary downtrend line, just like QQQ. So that together forms this kind of a potential bullish falling wedge pattern. My outlook on treasuries, which, I'm long treasuries for several reasons, but I think we might see a abatement in yields, which if we do, and as long as it's not associated with a stock market crash, that should be, quote unquote, should be net bullish for the stock market. I can't see why stocks, unless, again, we're in, if things have just broken now and the institutions are selling to, kind of mitigate their losses and risk exposure and everything else, where you hit that kind of final point where the market just starts to melt down. If we're not here yet, we could get a little rally up. And I hate to say it for the bearish case, but if that happens too, it's just going to firm up this wedge. But we'll have to see. Apple's only one company. We'll have to look at the rest of the market leading stocks and other sectors, which I'm about to get into. So there's that. Apple. Let me go to my other main board. I'm sorry I didn't have this is my primary board. And remember, Apple's still on my has not yet. In fact, it closed on and bounced off so far. That lower purple line, I told you, to me, it's not a kind of all-in market craters moment until all these purple lines get taken out on the big market leaders. Microsoft still well above, holding the 311-ish. Key level, Alphabet, I said, these should have been purple. It's a key support zone. They took out that one purple line. But look, when it did, you can see there were key support levels. Sometimes I have one, sometimes I have two. Once that level was taken out, it went down. And so far, it's holding the level, and it's also holding the 200-day moving average. So again, this is, I know I'm being a little redundant, but these are the market leaders. I do see them going a lot lower over time, but it's just in the near term, they could actually have a pretty healthy rally. This is where, if this market's got a little life left in it, this is where the buyers should step in, and they need to. And if they don't, that's why we could see that quick swoon down to some of those deeper targets, including this trend line here. I'll color it up. My chart's starting to look like a rainbow, but and it's a big trend line, make it a little thicker. That one comes off the lows right there, and that would be a deeper target if we smash on through these support levels that so far we're testing this week. Amazon, I already covered that today. Clean reaction, so that helps to validate that trend line off the lows. That's its primary uptrend line right there, but it also ran smack into its downtrend line right there. So kind of pinched between, a lot of things are triangling right now. They're forming triangle, either symmetrical or asymmetrical triangle patterns, which could also determine the next big trend if we pop to the upside or downside. I have quite a few things. I'll get to that in a second when I get to the sectors. But also, again, we had positive, aka bullish divergence. So this is why you don't want to stay. Remember, I keep saying when you're short selling, you can't stay too late to the party. So let's say you were short Amazon, and you took and you held it into earnings. Well, you got smoked today. The stock was up. It was up a lot more in the morning. You probably would have stopped out there. Remember, guys, if you use stop loss orders, good to cancel. Stop loss orders are instantly converted into a market order once your stop price has been triggered. So if you were short Amazon, you went into earnings last night short, and you had a stop, let's say right here. That's where we closed yesterday. This is just a 1 minute chart. There's your stop. Well, guess what happens? When the market opens, your order, along with everybody else's stop loss order and all the bulls that are buying, they fired off at one point in time, and so that's where you get those order imbalances. That's what causes a big old gap, and that's where you get filled. So your loss is a lot higher. And your alternative, you say, no, Randy, I won't use stop losses because of that reason. I use stop limit orders. Well, a stop limit order says, sell me out. I'm short. Cover my short if and only if Amazon, if it crosses 121, but sell me at 121 or better. A limit order says 121, whatever your stop price is, stop limit price, but no worse than that. So a short seller, if it gaps up here, you're still short the stock. It will not fill at this point. Your stop part of it's been triggered, but the fill will only come if Amazon now crosses to 121 or lower on that order. So there's really no easy solution, and that's, again, one reason I like futures, because if Amazon they had futures like the indexes, that trade around the clock, well, this would have come up, overnight, and you could have been, stopped out or gotten out wherever you wanted to and sidestep the gap. All right, so that's that. Very aggressive buying and defense of the 200-day simple moving average and the primary uptrend line, and so far the divergence is starting to play out. NVIDIA is still at support, so it's the same video I did earlier today. Like I said, I don't like the action of the banks. I'm going to get to that in a second. But on the flip side, a lot of key stocks are still at and holding and defending support, whether it's key moving averages, 200 days, or price support. And so you can't get overly bearish yet. I haven't waffled on where I think things are going in the coming months or years. It's just, if they want to do this first, and there's a chance I can ride that and then reshort at a higher price, that's what I do. And if they gap down Monday, real big, I will reassess at the time. I'll get my thoughts out to you. I'll either sell the mild long exposure in the indexes I have, or I might add to it depending on where we gap down to. We'll see. All depends on what happens. So that's how the market looks. There's Tesla. Tesla had a big triangle too, right here. Boom, boom, broke down. I didn't draw that line clear. Broke down there, and you can see that's where it went after. Once it broke down from that near symmetrical triangle pattern, the trend was clearly bearish. All right, sectors, and then we'll wrap this video up after a few things to watch stocks. As I'm going through these sectors, again, there's 11 in the S&P 500. I'm doing these in order of market cap, or weighting, I should say, weighting in the indexes. So this is tech, 25.74% weighting through the at the end of 2022. That's going to change over time. There's their components. Microsoft is 22%, Apple. So those two alone make up almost half of the XLK, the tech sector ETF. Tech, positive divergence. Same kind of, and it's not coincidence, mere coincidence. This looks like Amazon and Apple and all these potential wedges. And, that could be the whole new high scenario. And that's why I can't eliminate it yet. These wedges and divergences play out. Other than that, on the downside, if it's got the 200-day moving averages just below, and my next target is down here. We already broke this 63 support, which was a big support. It's a thin zone all the way. I don't have a support level until all the way down here to about 157. And so we'll see next week. Me, I'm mildly long the text right now, and mostly just via NQ. I told you I have some, Alphabet I took yesterday and added to this morning. And that's actually, even though I'll get to Alphabet in a second, I already covered it. Even though it's flat today, I had it down this morning at the open, and so that was actually, here we go, a little bit, some slightly positive, but almost flat. It's not anywhere worth taking a profit yet because we're right back to where we, a little bit above where we started yesterday. Okay, tech, we did. Here's healthcare. This is everything else I haven't covered very recently, but it's things I watch these are things I watch every day. It's been a massive trading range right here. You can see that for XLV healthcare sector. I had it marked back there, the shaded box, and highlighting these were 3 false breakouts, and then right back down in the range. Let me use my box tool here. And so that was where I had the box. It just comes across. This is the most massive here. Let me do this for you so it's not all busy looking. You can box it like this. The bottom really is what you, and so you can now take the top of the box up to here. But look at that, just so many reactions with a couple whipsaws to the downside. But it's hard to deny how many, this is just where it's been a year, almost 2-year long trading range in the healthcare sector. And we're pushing the bottom of it now. Look, the thing is, when you recognize a trading range, if you just want to do the keep it simple, stupid kind of rule thing, you buy pullbacks to the bottom of the range. You go long with a stop somewhat below. Sometimes they're going to get you. This is where the market makers play their little games and the algos. And they got you. So you would have had to have a pretty damn wide stop there. So let's just say the right thing to do would have been stopped out. But guess what? If you got stopped out and or shorted, once you recover, that tells you that was a false breakout and a whipsaw. So you can get back in long, or if you shorted it, cover your short, because then the next stop is usually at least the midpoint of the range. When you have a trading range, that tends to act as support and resistance, or the top of the range. There was another whipsaw to the downside, and this thing just rocketed back to the top of the range. So that's kind of the MO. Go long at the bottom of the range, short at the top of the range. Long, short. Long, short. And now we're back to the bottom of the range. So you can either go long here with a stop below if you think the market's going to hold up, and it might, where it's, support is support until unless broken, as I like to say. Or we break down. And let me just add to this. When I recognize trading ranges and price channels, there comes a point when they get very long in the tooth, that whole MO of buying the bottom and selling the top, the odds of it continuing to work start to diminish greatly. And so you don't, sooner or later, in other words, sooner or later it's going to break out. You're not going to see, I've never seen a big sector like healthcare or the stock market trade in a range for much more than 2 years. This thing's going to break one way or the other sooner than later. Odds favor to the downside, but we might have a little pop before that happens. Maybe, maybe not. And just respect whichever way it breaks. Either way, that's, by the way, guys, that's the second largest right there at about 16% weighting in the S&P, so it does matter. It does move the needle. XLF financials, as I said, only a 12% weighting, so half of the what the tech sector is on the S&P 500, and so it's not going to move the needle as much. But as I said in those comments earlier today, there is not a single sector, not even a remote, not even a close second, is important to the financial system, because if the banks break, if they break, financial, they stop lending, and everything comes to a grinding halt. It doesn't matter how many iPhones Apple sold last quarter. If you start seeing major problems in the banking system, the Fed has to come to the rescue again. Yeah, it's gonna have impact the economy. Okay, all right, I had to turn a setting off on the computer. All right, this is it. Remember I said a minute ago, I'm seeing quite a few of these triangles. This is XLF, and this is, of course, my busy board. I have all prior trades and divergences and everything, but the big picture, and I'll turn off all the lines and draw it out nice and clear. This is, here's your bull market highs, or, the highs from 2021. There's your downtrend line, primary downtrend line, and then you have the uptrend line right here off the lows, and that gives you a symmetrical triangle, which we just broke down. I have it drawn like this, so if you want to come in here, so I just kind of freehanded it there. This is a tighter fit. Unfortunately, if I turn off all the lines, it goes away, but here I'll do it one more time. So if I come in nice and tight on the bottom of this candle here, there it is. So we're right on there. That's how I should have drawn it. So we're at a pretty key support level in the financials. And again, JP Morgan was really, and I'm looking at the big banks, they were all down, don't get me wrong, but JP Morgan, and JP Morgan is the largest bank in the financial sector. It's the largest bank in XLF, the financial sector ETF. The only company larger is Visa, and it's slightly larger, and we know what's been going on there. That's a current short trade on the site, everything else. And JP Morgan, and I started picking on the banks back here, right there. I got to post out to you today. Banks, the financial sector, I've done quite a few videos, and this one's playing out. Here's Visa, the largest. And look, right at the neckline now. So this is it, guys. I mean, like I said, maybe we get one little bounce off the neckline before it breaks, a little tradable bounce. Well, if it does break, there's your measured target right there. First target on Visa is T1 zone. Remember, we shorted it ahead of time. MasterCard already close to the T2 already. We shorted this one also in advance of the breakdown recently. But it was first highlighted back here as a short, and many times since on the break of the big bearish rising wedge. So again, there's so much in the charts lately. There were so many reasons to be short. You can short the top of a right shoulder once you see the pattern forming. That's one of my favorite strategies when you see a right shoulder form, especially once it turns in short with a stop above. It's either going to pan out and form into a head and shoulders pattern, finalizing the right shoulder, and then you just got a better entry. So, and then you can, of course, short also break in the neckline. But again, we're coming up on support. So I just showed you Visa is at support. It's at its neckline, which is support. And MasterCard is just a hair above the second target, which I had price support as well as the head and shoulders measured target. So either way, that's what I was watching today. It was big banks, and again, just kind of looking at it. BKX is the bank sector. You can see that's down. That's also flirting with its previous bear market lows right here from 2023. It's getting close there. And let me just look up and see if anything stands out. No. I think KRE most of the day, well, no, KRE ended up closing down as well. KRE is a regional bank sector. And again, not any one regional bank is as important as the big banks, the too big to fail, but collectively they are. So keep an eye on KRE. They've been the regionals have been sucking wind lately, and then you look at individual regionals, and a lot of them are just blah, just not looking good. So look at all these charts, and then I'm just picking on some out of the regional bank sector ETF. I mean, this is massive support. This is where when the banks were failing earlier, it's testing that same level. So looks like a lot of these regionals are going to go bye-bye, and it's just a matter of, do they go out in an orderly fashion, or is there just a systemic failure that triggers a domino effect, and we see just kind of gridlock there, because the Fed can only do so much. We already have ballooning federal deficits. What are they going to do? Just extend unlimited FDIC insurance, and taxpayers are going to pay for everything? No, they've supported the financial markets too long, too much, and with now one of the biggest worries is our spiraling budget deficits, and we can't balance a budget, and we keep having the gridlock in Washington, and Treasury yields are reflecting that. So for the first time in many of our lifetimes right now, Washington just doesn't have, they can't continue to be nilly-willy on just throwing money at whatever they want to throw money at. The bond market's checking Washington right now, and they're certainly checking them hard. So anywho, where that goes is, everyone's like, in recent years, and that's what we saw in March. The market rallied after the two biggest bank failures in U.S. history, and ultimately the stock market rallied because the Fed came in to the rescue once again. And all I'm trying to say is that you're going to get to the point where that's not going to continue to happen indefinitely. All right, let me move on. Let's see the other sectors. Okay, I covered XLF, showed you the big triangle pattern there. We're at support at the bottom of the uptrend line, but if we go much lower, we have price support here. We shorted them back here as well. XLF, third and final target was right here. And so it was support. We tested it again and again. So if we break there, 30, 40, but anything much below that, anything much below that, guys, and then the financials will now be at new bear market lows, and that's not going to be good for the stock market. And tech is so high up. There's such a disconnect with the tech sector and everything else. XRT, the consumer, the retail ETF, and mainly the financials and things like this. So if the banks crack down here and start heading down to new multi-year lows, I can't give you a promise in this thing we call investing trading. I can't use the P word or the G word, guarantee, but I can all but guarantee and all but promise you that if the banking sector continues to do this and breaks down, starts waterfalling down to multi-year lows, it will drag the tech sector down, and those beloved FANGs and Apple, everybody's crowd favorite, NVIDIA, king of AI, it's going to drag those tech stocks down kicking and screaming. And because there was such a disconnect, the reversion to the mean is going to be vicious and violent. You don't want to be in big tech if the financials break down and a lot of those other potential red flags. Don't underestimate how far and how fast they can drop if that happens. So here we are, we're redlining. I talked about it. The engine's been, the tachometer's been hitting the red line for the last few days. This market could very well break, and the bottom may fall out of it next week or the following week, or sometimes you hit the red line, and if you back off soon enough, the engine doesn't blow. So if we can rally up here, watch the financials next week. What else? I'm not going to go over every sector because the weightings as I go down the line. Now we're on the fourth largest, and it's only 9.8. That's XLY, consumer discretionary. Of that 9.8, it's almost all Amazon anyways, and with a little bit of Tesla and Home Depot in there. So really Amazon's going to make or break this. And then you have industrials. Obviously, it's kind of more of a tell on the U.S. economy. You see the industrials moving sharply lower. There was a false breakout, aka bull trap right there. That was multi-year highs, new bull market high in the industrials. And as I often say, it was, came with a divergence and a little wedge break, and boom, we're back down. But we're also at support right there. I have that yellow line. Communications, that's all Meta and Alphabet right there. Wedge breakdown. Let me give you a few more things and we'll wrap up. So let me just look at my things to watch list. regionals I already covered. JP Morgan I covered. Moody's. Oh, you look at here's what continues to just warn of what's going on in the economy. So remember, 2 days ago or yesterday, I'm sorry, blowout quarter in GDP, and everyone's economy is still resilient. Consumer continues to spend. They're not gonna let the stock market or the economy roll over because consumer spending is 2/3 of GDP. Blah 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 blah. Remember GDP, for those unaware, it's basically called the earnings of the United States. It's our gross domestic product, all goods and services produced, and so. But this is a tell. This guy's always been a tell. Go back as long as you want. Put on UPS and FedEx. These are the red flags I'm talking about. So they're there, and this is why I keep talking. I'm showing you a lot of stuff here that if this stuff continues and we don't, we see one key stock or key sector. Remember, UPS is much more important, I think, of trying to gauge what's going on in the economy than, I don't know, pick a stock, pick a blue chip you want, even Coca-Cola, something like that. This is a big one. And then, of course, not just UPS, but it's partner in crime. Where is it? Yeah, I'm looking for it on my watch list, but I'll just type it in, FTX. FedEx also just broke down. Pretty decent support right there. So, and it, the chart says it's going lower, indicates it's going lower, at least down to this level. But big question, we're going to get a little kickback. And again, these guys don't matter really to tech, but they're red flags. If you see FedEx and the airline sector, that was the other thing. Remember, I started picking on that a few months ago because everybody loved it. And was the restaurants, airlines, and the whole leisure sector. And that was it. And that's where I started highlighting the airlines and restaurants as shorts. And sure enough, that was the end, because they were saying, the consumer's so resilient. They're just going to keep spending and going out to hotels and taking vacations, and boom. And so that's not the case. This is telling you what's going on. And look at that, the airline sector just sliced through. And there was a big false break. You had a beautiful downtrend line, right? There's a bear market downtrend line. There's your uptrend line. Big old triangle. Breakout. Almost bullish on face value. A lot of folks were buying the airlines here, but that's where I highlighted as a short. And now, see, we failed it. And this is what happens. That's very bearish. When a breakout fails, you usually just keep going in the other direction. Now, I don't know where they're going from here. Well, I wouldn't short them. I don't have any position right now in the airlines. But it's a tell on the economy. If people were still booking a lot of vacations and travel, despite rising oil prices, which they should have been hedged against, the good ones, would the airlines be in free fall like this? No. So a lot of this is real time stuff, guys. When you're looking at the stock prices of the airlines, of ADP, when you get the jobs number and the government reports, that's usually dated information. Sometimes it's inaccurate information, but when you see the big payroll processors coming down hard like this, that's a tell. It's kind of a heads up on what's going to happen. What are the job numbers going to show soon? Because that's the one pillar that the bulls can really prop themselves up on lately, is that the job market has been at historic lows and very strong. And as I've showed you before, I'm going to wrap the video up here. I'm not going to pull it up because this video has gone long enough. Go to macrotrends.net or any of that. Just Google search an employment report, and then go to historic employment U.S. and then get one of those that will let you overlay the S&P 500. And what I've said before, it's almost a contrary indicator, because if you look at employment, the charts over time, over decades, and this is 3% or whatever, record low unemployment. Every recession, every bear market starts from here, not here. So, the fact that we're down to those record low unemployment levels, we're at the same level that, in other words, it's not going to get any better. It's gotten as good as it's going to get. And that's usually where, and always has been, where the recessions begin. And I also mentioned, too, when you look at those charts, you don't hit 3%, stay there for years or a long time. It's usually once you trough in the unemployment data numbers around the 2-3% range, 3% or so, then that's usually a quick reversion. Then this recession hits in and layoffs start, and then the cycle repeats, and then the recession will soon follow. All right, I'm going to wrap it up here. I know I threw a lot out to you. I know I've kind of been all over the place lately, highlighting both potentially bullish, not so much developments, highlighting support levels. There's haven't been any bullish developments, but what I've been showing you, if you care to game longs, are pullbacks to support where the buyers may step in, at least for a rally next week, maybe more. But if it doesn't happen, we're also at that point where things may just snap. And a lot of things are at key support levels that could just get taken out and we could just head down. So I don't think that's going to happen until Apple's out of the way, at least until Apple's out of the way next week. But I wouldn't bet heavy on it. That's my message. All right, guys, I'm going to wrap up here. It's been Randy Finney with Right Side of the Chart. Have a great weekend.